Leslie, you cover IPOs. We say wearables are about to hit Wall Street. The truth of the matter is wearables are already on Wall Street in the form of Garmin. Garmin just happens to be a much bigger company that makes navigation devices, GPS, but fitness is actually a much bigger part of their business than people realize.
It absolutely is, and this company is coming in more expensively than Garmin is currently trading. So people obviously see Fitbit. It's the market leader. They see it as a value proposition due to that place it holds in the market right now. It's already gotten a widespread adoption among users. Obviously, there are a few risks, though, that we can discuss.
That's always the best part of any kind of IPO filing, right? Looking at the risks section, and the legal risk you're referring to is what Eric has on his wrist, the Jawbone, the patent infringement lawsuit against Fitbit.
Yes, absolutely. So 2 lawsuits from Jawbone over the last month. This is pretty common leading up to an IPO. It's a time when a company is about to be cash rich. They don't want any kind of publicity blemishes, so they're more likely to settle. So it's no surprise that Jawbone timed that right before the IPO. However, obviously, if it does settle, it could be an expensive settlement and one that could potentially be a setback for Fitbit. Aside from the legal issues, they're also facing competition from Apple. Apple's iWatch happened to just come out right before this initial public offering, which is also curious timing. However, it does provide, at least on a price standpoint, a much better value to consumers. The most expensive Fitbit is $250, whereas the cheapest Apple Watch is $350. So, and goes all the way up to $17,000, as we know. So it's a much cheaper proposition, and that could attract more from the corporate side.
Talk about the valuation. Fitbit is looking for a valuation of what? As
high as $3.3 billion. And so on a price-to-sales basis, that's about 4.4 times price to earnings, because this is a company that is profitable. Yes, I said the P word. It's profitable, and it's a tech company that's going public. On a price-to-earnings basis, this company is looking at about 25 times, and on an adjusted EBITDA basis, 17 times. So right now, it's looking at a pretty decent valuation. It looks like they're valuing it on a price-to-sales basis relative to peers. It is more expensive, of course, than Garmin and Apple, but cheaper than GoPro, which is the latest hardware company to have gone public.
Yeah, but GoPro is a media company, right?
It's a media company, exactly, with a media valuation.
Leslie, thanks very much. Leslie Picker on Fitbit.